Welcome back. Thank you for staying with KTN Prime. Now, ahead of the discussion that will be centered on Kenya's tax policy and the evolution of the payslip, we just want to take a look at some of the statutory deductions in the payslip that employers will be deducted. Let's just start with the SHASHIF, which is 2.7%. As you well know, the employees have 2.7% of their gross salary automatically deducted from their paychecks as their contribution to SHIF. No employer, equally, there's no employer matching, unlike other insurance schemes where employers do not need to match the employee's SHIF contribution. The minimum contribution, regardless of the salary, each employee must contribute a minimum of 300 shillings per month. It's also proper to note that Treasury CS John Mbadi in November last year proposed that SHIF and housing levy deductions should be made before from gross salaries rather before taxation. According to him, it's intended to increase the take-home pay for employees. That's on SHASHIF. On the payee, pay as you earn, just to break it down for you, it's a method of collecting tax from individuals. This is all to do with the pay as you earn, and it is deducted by the employer. The tax rates range from 10% for the monthly band of 24,000 Kenya shillings gross salary, all the way up to 35% for gross salary above 800,000 Kenya shillings. On the housing levy, it involves a mandatory deduction of 1.5% from an employee's gross salary. Employers will also contribute an additional 1.5% of the employee's wages, resulting in a total contribution of 3% to the government's Affordable Housing Fund. Now, contributions are split between employer and employee, with each party contributing 6% when it comes to NSSF deductions, where the employee contributes 6%, employer 6%, all to do with the employee's monthly pensionable earnings. Now, the amended NSSF Act introduces a tiered contribution system, replacing the previous flat rate contributions, and there are two tiers. Tier 1 applies to earnings up to the lower earnings limit that's currently set at 8,000 Kenya shillings per month. Tier 2 applies to earnings above lower earnings limit that's earning over 8,000 shillings up to the prescribed upper earnings limit, which has been adjusted progressively. There are changes to NSSF deductions that have come into effect this February in year 3 of the NSSF Act, which is adjusted progressively, as I mentioned. Let's just take a look at previous 2024 deductions. For the lower earning limit, Tier 1, those earning up to 7,000 shillings would be deducted 420 Kenya shillings for NSSF contributions. That is from both employer and employee. The upper limit for pensionable income is capped at 36,000, meaning the maximum deduction is 2,160 from the employee and an equal amount from the employer, totaling to about 4,320 shillings. That's in 2024. Now, from February 2025, the pensionable income upper limit has increased to roughly 72,000 Kenya shillings, meaning the maximum deduction will be 6% of that 72,000 Kenya shillings. That's roughly 4,320 plus a matching employer contribution totaling to about 8,640. Equally, the pensionable income lower limit has been increased from 2024, where it was 7,000 Kenya shillings. In 2025, it's at 8,000, meaning the maximum deduction for the lower limit is 480 Kenya shillings. That's roughly 6% of 8,000 Kenya shillings, marking an increase of deductions of only, let's say, 60 shillings for Tier 1 contributions and a double increase for Tier 2 contributions. Let's just take a look at the pay slips and how they've been faring on over the years. In January 2022, that's the figure for someone who was earning roughly 40,000 Kenya shillings. NSSF deductions are made. The gross salary deductions, taxable pay, the payee before relief, and the NHIF deducted and other deductions, you will be earning roughly 34,627 after all the deductions were made. That was in 2022. Let's take a look at the following year, July 2023 to Jan 2024. If you're earning roughly 40,000 shillings, you'd be taking about 33,411 Kenya shillings, including all deductions that we mentioned a little bit earlier, payee, talk about the NSSF, the SHA contributions, and the housing levy. Over to the next year, 32,660 is the net monthly salary for someone who is earning a gross salary of 40,000. If you take a look at the deductions that have been made, including NSSF and whatnot, you'll be earning 32,600. That was last year in 2024. Now, that is how the payslip has evolved across the years. If we could just go back to the previous board, as you can see, in 2024, it was 32,660. If you are earning 40,000, you'd be taking home 32,660. In 2023, if you're earning 40, you'd be taking home 33,411. And in 2022, if you are earning 40,000, you'd be taking home 34,627. So you can definitely see how the payslip has evolved, taking a look at some of the deductions that have been increasing, bearing in mind NSSF deductions, as we mentioned earlier, will be coming into effect this February. So your February payslip will mark an increment in deductions slightly, but it's still a dent on the payslip. Ashley, over to you.
All right, thank you, Jesse, for those numbers. Let's now introduce our guest here in studio. Next to me is Kiplimo Kigen, who is the head of policy research and advocacy at the KNCCI, which is the Kenya National Chamber of Commerce and Industry. And next to him, Odhiambo Ramogi, an economist and a CEO at LM Capital. Good evening, gentlemen, and thank you so much for making time.
Thank you.
I'll start with you, Ramogi. Salaries are shrinking, deductions are rising, Kenyans are not happy. Your initial reaction to all this as a Kenyan, first of all, before an economist?
No, of course, naturally, no one would want a shrinking salary because, one, it means then that you do not have disposable income. You know, the cycle of growth is you get an income, you get out of the income you get savings, out of the savings you get investment, out of the investment you create more jobs, and out of those jobs you create income again, and the cycle continues. When you disrupt that cycle with overtaxation, what means is that you are hindering growth, you are hindering economic development, as it were. And so I think that's what's going to happen. We are going to see growth hindered by this overtaxation, especially in the longer term. You had asked what I feel about this as Kenyan. Of course, it also means that you cannot buy the things you want to buy. But the other thing that we also need to put into consideration is that the population that is employed in white-collar jobs is about 3 million. And these ones, out of 20 million possible workers in the Republic of Kenya. Now, of the 20 million, there are many of them that are not employed, underemployed, or out, or just have been out of job for too long. You no longer can categorize them as unemployed.
Yeah.
These mostly depend on the 3 million who have formal employment. And so the dependency ratio is quite high. That's why someone earning a salary, a very good salary, you will find a gentleman parking a very big vehicle, machine, next to a kibandaski, because he's trying to save so that he can pay his black tax to the village and make sure that his nephew goes to school. The problem of a shrinking payslip means that that nephew's education is affected. It means that all these dependents are also affected. So it's a bad place to be as a country, it's a bad place to be as a worker in the Republic of Kenya.
You know, Kegan, coming to you, I mean, he says it's a bad place to be, but then on the other hand, we're seeing the government insist that, you know what, our economy is doing well, inflation has gone down. Are they aloof, or there has to be a missing piece there?
Thank you for that question. Indeed, we've seen improvements on the macroeconomic side, inflation, interest rate, and even our currency. But macroeconomics mean nothing to the operations of a business if the microeconomics do not make sense. Okay. If issues like high cost of living, disposable income are still there, then the macroeconomics do help things improve, but they don't actually, you know, it's not a silver bullet to achieving what the country needs. But from the private sector, you know, the NSSF, we've seen a wave of deductions, the NSSF being the most recent one, which, you know, the doubling of from 2,160 to 4,320 on the higher side. What this does for the private sector is two things. One, it actually indicates how haphazard our tax policy is. Now, why do I say that? Going back to the Tax Laws Amendment Act that was passed in December, it provided relief that now affordable housing levy and SHIF are going to be deductible. And it was a very welcome move by the private sector and even by the general public that indeed now we've actually gone ahead and saved the payslip. You know, there'll be a bit of easing on that end. And it was a good thing. But now, less than 2 months to go, because indeed in this February's payroll, NSSF would have increased. Then you wonder, we were doing that in December with the notion of supporting the payslip. Then 2 months down the line, we are doing something, you know, in the opposite direction of that. So then the country then starts to wonder, what's the economic plan? How concrete is the plan? Is there even a plan in the first place? Yeah. And the second item is what my colleague has talked about, disposable income, of course. There is a concern, you know, if you look at, for example, if someone earns 100,000 Kenya shillings, and that's a really, really good salary, that's the minority of Kenyans, you see that what they'll take home today after all the deductions is about what? Maybe about 62,000. But then
what can you do with 62,000?
Yeah. And again, that's not the reality. The reality of many Kenyan households is that you find they've leveraged that payslip on a couple of loans. Maybe you've got parents has taken some school fees loan to take the kids to school, some emergency loan somewhere. If they're spending even like 20,000 every month to repay the loans, they're ending up with about 42,000, give or take. So 42, you're getting 42%. That's actually what you have as take home. Yeah. And if you do the math on still that 100,000, you find that now, because NSSF is the first thing to deduct, if you look at the payroll, how it's arranged, you find that now there'll be less, about 1,408 Kenya shillings if someone earns 100,000. Now, to policymakers, this might sound like very little money. But right now, a bucket of unga ugali, 1 kilo, costs about what? Maybe 70 shillings. And a kilo of sugar is about 150, 160 shillings. Yeah. That 1,400 shillings would buy you 10 packets, you know, about 6 packets of unga and 6 packets of sugar, which is quite significant to the household basket. Now, if disposable income has shrinked, then that means that the citizens of Kenya are not able to buy the products that we make as private sector. Then that reduces our opportunity to be able to grow. And the other thing that we are also seeing as a trend in private sector is that, you know, at the end of the day, businesses have to match the deductions, particularly the affordable housing levy and NSSF. So that means that, you know, payroll is a cost to a business. So their cost of doing business obviously goes up, their cost of production. Now, you see a trend where it gets to a point where you find businesses want to pay their employees off the books. Because right now, if I'm paying you 100,000 Kenya shillings gross, you'll be receiving about, what, 62 as take home. Right. Then if I tell you that I'm going to give you 80,000 off the books, as my employee, you saved about 20,000.
You'll take it. It's a good deal.
Absolutely, you take it. So it's like we've created a black market for payroll. And I mean, businesses always want to pay tax as long as it's fair and it's sustainable.
And in the long run, what kind of effect does it have, considering we don't even meet our tax collections in the first place?
Let me start where he's left off. What businesses are forced to do. Yes, businesses are forced to evade tax. It's hard to say that on live national television, but it's happening. But the other thing that businesses are forced to do is to review salaries. Because when your employee is demotivated, unable to meet his needs because of the tax burden, you as the employer, you need this person to still be able to deliver on the things you agreed for him to deliver or her to deliver when you employed them. And so you are forced to ask yourself, what else can we do to make sure that this person can actually survive? And you have to review those salaries to at least meet the tax burden halfway. I saw the Salaries and Remuneration Commission attempting to do that on state officers, and it backfired. Millie Mabona told her that, I don't know whether it was Millie or the senator, that she did not read the room, that it was the wrong time to increase the salaries. But she was doing her job. You have to look at the tax and look at the people, and you review, which is what most HR officers are doing in major corporations today. In the long run, this has several impacts. One is that, of course, the cost of doing business has gone high, both in terms of the business itself has to pay taxes, the taxes that are imposed upon it, but two, has to take care of the cost of taxes to its employees. And I think that will affect growth. You have seen many businesses signing up for, to be wound up because they are unable to meet their costs. Let me also comment on the tax policy that he mentioned on. Yes, we have we say that we have a tax policy, but the tax policy is silent. Someone sat down, drafted that document, passed it through the procedures, and then it was nicely filed and put away. And then now we have to come back and say, what is the finance bill of this year? And in the absence of finance bill, come up with something, haphazard we call tax amendment bill. That it is very hard to define. No one wants to call it finance bill, but everybody knows it does what the finance bill does. And so I think that is a very bad place to be. The others, I'm finishing. The other time, Mbadi, the Treasury gentleman, said that he is considering lowering taxes.
Yes.
And that's a very good consideration. You see, the problem we have is that payee is the highest earner of revenue for Kenya Revenue Authority. It is followed by VAT, which is followed by duty, and then corporation tax is down there, which means the majority of the taxes that work in government come from your pocket. So if they wanted to review taxes and look like they are reviewing taxes, institutional negotiators, corporations have institutions that negotiate for them. The Kenya Association of Manufacturers, Kenya Chamber, will go and sit down and they will negotiate, and Mbadi will tell them, okay, I will reduce something. Mwananchi, however, does not have someone to negotiate for him because Kotu is even negating what FKE is saying. FKE is saying that things are bad. Kotu is saying things are not bad. Atuoli doesn't feel things are bad. And so I don't think Mwananchi has someone to go to Mbadi and tell Mbadi that, and because you are his number one earner, I do not think that is about to change. I don't think that he's going to be able to adjust payee to a lower level.
Okay.
And in the absence of that, and because he has packed your CV with shisha, with NSSF, with all these other things, including housing levy, it's very unlikely that in the long run this is going to change.
Okay.
I'm just saying what I foresee.
All right, and in context, and for the sake of our viewers, maybe let's just listen to what the Treasury CS had to say during the Bunge la Wananchi that was held on Monday. Let's just listen in.
Nataka itekeleze maendeleo ambayo itabadilisha maisha ya Wakenya. Watu wengi hawajaelewa ile maneno tunajaribu kufanya. Kenya hii haiwezi kubadilika bila ya uongozi ambayo itaamua vile Kenya hii itabadilika. You cannot transform a nation by making ordinary decisions.
Have moved towards reducing the burden, the tax burden on your payslip. VAT, take it from me, we are not increasing VAT at all.
All right, that is President William Ruto during his current tour, and of course the CS Treasury John Mbadi there, just talking about the VAT, and equally talked about the fact that he will look at how he can improve the VAT and reduce taxes for Kenyans. He said he's not thinking like that the plan is going to work. Are you of the same view?
What I am very keen on is action and intentionality. Now, the engagement that the Honorable CS had with Bunge la Wananchi is actually a good thing. And it's the interaction with the public, and I think the government quite realized with the political issues last year that we need to speak more and engage the citizens, which I don't see harm in it. And some of the items that have been mentioned by the Chair of the Revenue Authority, as well as the CS of Treasury himself, particularly on matters predictability of the tax regime and matters finance bill. Now, from the private sector, we had the tax laws amendment which kicked in December. It became law in December. And if you are going to say that we're going to have a finance bill in 2025, which is going to come in when? May, April? You're going to tell me that we are going to have 2 finance bills in a span of 6 months. In which market, in which economy are you going to have 2 finance bills in less than 6 months? It goes ahead to mention the item of the national tax policy. Yes, we have it. This is one of the items that's anchored in the national tax policy is the predictability of the tax regime, because businesses need to plan when they'll recoup their capital. They need to plan based on expenses and things like those, and also taxation. So if that is not available, so for us as private sector, we are actually expecting not to see a finance bill in 2025. The CS has alluded to it, the Chair of KRA has alluded to it, but the actions of government don't point towards that direction. If you look at the budget policy statement that was issued in January, which now will inform the financials of the financial year 2025-2026, you realize that the government actually is looking to raise about 343 billion.
Okay. So
in essence, it's telling you that there's a finance bill that would be about 343 billion, which then makes me want to doubt, the sentiments coming from the CS and the PS, from the Chair of the
I want you to hold that thought.
We are both doubting Thomas.
Okay, so hold that thought. And we just want to take a short commercial break, and we'll be back with this conversation.